Preet Banerjee is back. Nice to see you.
Nice to see you guys.
Good morning. Preet is a personal finance columnist. He's worked in the industry and also hosts Million Dollar Neighborhood now. We read something by Paul Krugman in the New York Times recently, and he was commenting on the Canadian housing market. And essentially what he's saying is, if I can jump down to the part, he recounts what happened in the United States. And then says, enter Canada. Famously, Canada's old-fashioned, boring banking system avoided getting caught up in the global financial crisis. And for a while, Canadian housing prices lagged those south of the border. Since then, however, and Canadian household debt keeps rising to U.S. levels, if the new non-bank centered view is right, Canada ought to be quite vulnerable to a big deleveraging shock, despite its boring banks.
Yeah, it's quite a mouthful. Essentially what he's saying is what happened in the States was fueled by bad debt. And a lot of people are thinking, well, is that the same in Canada? The gist of the article was, if you take a look at Canada now, he's saying it looks a lot like what happened in the U.S. right before their meltdown in housing, but there's a couple of things that are quite a bit different. So as I said before, the buildup in toxic debt in the U.S. was rampant. So you could go into a bank and you could actually get a ninja loan. Now, that's not a loan for a ninja. That means no income, no job or assets, and you could get a massive mortgage. So that's never happened in Canada. And that precipitated this massive meltdown, which caused recession almost worldwide. And because of that, interest rates have fallen. And the falling interest rates, I would argue, is the reason why debt has grown so much in Canada. So it's a totally different beast in terms of the mechanics.
But Preet, homeowners get so confused because they see all sorts of different headlines in the paper. And if you pick up the Globe and Mail today in their real estate section, this is the headline that you'll find. Canadians handling mortgage debt responsibly, new report finds. The report was financed by the Canadian Association of Accredited Mortgage Professionals.
So that's an ad.
Yeah, basically an ad. But I mean, these are the things like, what are you supposed to believe, especially if you just bought a home and you think, am I going to lose my money? Am I going to be able to afford my payments if the interest rates start to go up?
Right, and that's one of the shocks people are sort of preparing themselves for, is an increase in interest rates. Now, that being said, interest rates have stayed lower longer than people have thought possible, and the forecast now is that they're going to continue to stay low. And as interest rates go down, a household that has the same amount of income 5 years ago as today can borrow a lot more money because interest rates have gone down. So that's what's fueled this debt-to-income ratio rise. In 1990, it used to be 75%. So if you take your total debt and you look at your total income, it was 75%. Now it's 165%. But that number doesn't factor in the fact that credit is so much cheaper. So there's more to it than just the headlines.
Now, how much weight should we put on these comments? Paul Krugman made this comment. The Bank of Canada warned that the housing market in Canada could put our economy at risk. And this is, I don't want to overthink this, but how much of an influencing factor do you think those comments are in actually creating an unstable economy?
That's an excellent point, because until now it's really been an internal call saying, look at the debt levels, look at what's going on in terms of credit. But now we've got Paul Krugman, Nobel Prize winning economist. You've got The Economist magazine, the OECD, the IMF, all saying, listen, Canada is so overvalued. And in fact, by one metric, the OECD says that we're overvalued by 64%, right? If you look at price to rent ratios. So now that other people are looking at it, it's sort of re-stirred this debate as to how bad are things. And here's my advice to people. If you're a homeowner right now and you're planning on staying in your house for the next 5 to 10 years, tune it all out, right? If there is a dip in prices, if you weren't going to sell, don't worry about it. Don't keep yourself up at night just trying to stress about it. Think of your home as a home, not necessarily as an investment, and you'll do fine. If you're looking at getting into the market, then you might want to take a closer look at your numbers. For example, I live in Ajax. We own a house and we're looking to move into the city, and I'm firm that we're going to rent until we figure out exactly what neighborhood we're going to be in. We don't know if we're going to move and stay in one place for 5 to 10 years. And of course, we would like to see what will happen with housing, right? We're still waiting to see. We're waiting for that shoe to drop.
So there's some, when you look at it, it's regional when you're talking about housing, the price of houses in downtown Toronto as opposed to Oshawa and Vancouver. It all differs. So when we talk about this city right here, the GTA, how's it looking? What do you think?
Well, you know, if you look across the skyline, there are so many cranes out there right now. We were looking at a condo down in the Distillery District. I stood out on the balcony, I counted 9 cranes without having to move. And, you know, just the change in traffic patterns alone for the next 5 to 10 years. The environment that you move into today is going to be totally different than what it'll look like in 5 to 10 years from now. And we don't really have a transit plan. So, you know, it doesn't really look like something I want to plant roots into until I can figure out exactly how things are going to look. So for me, because I'm in a period of transition, I can take that sort of hedged bet and rent for a while to see how things pan out. But again, for people who are already buying, I don't think you really have to worry about it.
Do you think there's a difference between getting into the condo market in the GTA and the housing market?
Yeah, absolutely. You see, the condo market is normally cited as one of the most overheated markets in Canada. The Vancouver condo market and the Toronto condo market. There's something like 18 to 20,000 units of condos coming online this year alone.
So much.
Yeah, but at the same time, vacancy rates are around 1%. So, you know, the market is
Which is
just
extraordinarily low.
That's
very, very low. Yeah. So
compared to the average
yeah,
vacancy
long-term.
rate in a big city.
So what would you recommend if you are looking at buying a home, whether it's a condo or a single family home, you put as little as you can down or put as much as you can down? I mean, what you know, with the rates being so low, do you take advantage of it, or do you just put a big, if you can afford a 20% down, is it better to do that?
Well, having equity is always a good thing, but I actually think what people should do, instead of looking at how much down they should put, how much house they can afford. Most people walk into a bank and they say, you are qualified for a $500,000 mortgage.
Right.
Don't get the $500,000 mortgage. Look at a price that's lower, that's more affordable for you, so you can withstand some shocks. Because we have this mentality: you give people $500,000, they will spend $500,000, right? And that's why you've seen, I think, a big increase in house prices. Because as interest rates go down, you can borrow more, and that's just fueled the demand, right?
Right. All right, Preet Banerjee, always good to see you. Host of $1 Million Neighborhood and personal finance columnist. Thank you.
Thanks for having me, guys.